Unity Software Inc. is an American software company best known for its ubiquitous real-time three-dimensional game engine Unity and a growing suite of developer tools that span from creation to monetization. Founded in 2004 in Copenhagen under the name Over the Edge Entertainment, the company shifted focus from game development to building a democratized engine platform, winning early recognition for innovation. After rebranding to Unity Technologies, the platform grew across mobile and PC gaming, embraced consoles, extended reality, enterprise, film, and simulation markets. Going public in September 2020, the company raised approximately $950 million in its US initial public offering. Over time, Unity further expanded through strategic acquisitions including Coda Software, Restar, PixieZ, Parsec, Weta Digital for $1.63 billion, Ziva Dynamics, and ironSource in a $4.4 billion deal, growing its footprint in development, content creation, networking, and monetization realms. Unity's business model revolves around two interconnected segments: Create Solutions, focused on licensing its engine to content creators across industries, and Grow Solutions, which provides tools and services for monetizing and optimizing content. Revenue is generated through perpetual and subscription licensing, consulting and professional services, advertising and analytics tools for game publishers, and transaction fees from asset store sales. Recently launched offerings such as Unity 6 and the AI-driven ad network Vector reinforce Unity's differentiated platform approach, targeting value across the life cycle of interactive content. In the first quarter of 2025 ending March 31st, Unity reported total GAAP revenue of $435 million, a 6% decline from $460 million in the first quarter of 2024. Create Solutions revenue of $150 million dropped 8% year over year, largely reflecting the company's portfolio reset that exited lower margin professional services and consumption-based offerings. Grow Solutions revenue fell 4% to $285 million, offset slightly by early adoption of Unity Vector. Despite revenue contraction, Unity notably improved profitability. GAAP net loss narrowed to $78 million, representing negative 18% margin, compared to negative $291 million in the prior year's first quarter. Basic net loss per share fell to negative $0.19 from negative $0.75. On a non-GAAP basis, adjusted EBITDA reached $84 million, representing 19% margin, improved from 17% a year earlier. Adjusted earnings per share was $0.24, down slightly from $0.28. Operating cash flow was positive $13 million with free cash flow at $7 million, a material swing from negative $15 million in the year-ago quarter. Unity exited the quarter with approximately $1.55 billion in cash and equivalents, balanced against roughly $2.2 billion in debt. Management issued guidance for second quarter fiscal 2025 revenue between $415 and $425 million, and adjusted EBITDA in the range of $70 to $75 million. Unity continues efforts to streamline costs and return to growth, driven by momentum behind Unity 6 engine, integration of AI-based vector ad network, and improved cost structure with lowered operating expenses. However, revenue decline raises questions around market saturation, developer retention, especially following the controversial runtime fee announcement and subsequent leadership change, and competitive pressures from Epic Games' Unreal Engine, mature proprietary engines from console incumbents, emerging AI-first development frameworks, no-code platforms, and internal tools used by blue-chip studios. In terms of recent acquisitions, Unity closed its ironSource deal in November 2022 to bolster its Grow Solutions suite with monetization and analytics offerings. Earlier transactions such as Weta Digital, PixieZ, and Codis have strengthened the company's asset creation, content pipeline, and enterprise positioning. These acquisitions have expanded addressable market and improved cross-sell capabilities, though cost synergies must be demonstrated over time. Unity has not declared or reduced dividends, maintaining a zero dividend policy directed at reinvestment and scaling growth rather than returning cash to investors. On management quality, CEO Matt Bromberg took the helm in late 2023 following John Riccitiello's ouster amid developer backlash over pricing changes. Under Bromberg, Unity has focused on rebuilding trust, resetting portfolio, reducing cost structure, streamlining governance, and reasserting its core product roadmap. Leadership's ability to retain top development partners and enterprise clients during this transition has been encouraging, though frequent layoffs, 600 jobs in May 2023 and an additional 1,700 in 2024, with further cuts in February 2025, highlight ongoing execution risk in balancing efficiency with innovation. Competitively, Unity occupies a leading position in the creator economy, particularly among mobile and indie developers, supported by a near-ubiquitous engine deployment across 2 billion monthly users and 1.5 million active creators by 2020. It faces stiff competition from Epic's Unreal Engine, especially in high-end console and film work. Smaller open-source engines for mobile, proprietary engines developed by console makers, and next-generation AI-based development platforms emerging from cloud providers such as AWS, Google, and Microsoft, and startups championing generative AI pipelines. In the Grow vertical, it competes with AppLovin, ironSource before its acquisition, Vungle, Google's ad monetization, and specialized analytics providers. Unity's scale, breadth of tools, and cross-platform support remain strong competitive moats, though distrusted pricing actions have opened vulnerability with some developers migrating away. Analyst coverage reflects this mixed narrative. The consensus rating skews neutral to hold. Jefferies rated Unity at buy with around 4.5% upside to a $27.27 price target. Conversely, Wells Fargo recently downgraded to equal weight, lowering its target from $22 to $19. Needham targets $30 with a buy rating, Macquarie sees 24 with a neutral rating, Morgan Stanley 25 with an overweight rating, while other downgrades have pushed consensus target around $24.47. Regarding technical chart posture, Unity shares trade above their 200-day moving average, near $22.28, and 50-day average near $22.82. Resistance resides near $30 to $35, the upper bound of recent trading ranges, while nearest support lines emerge near $20 to $22, reflecting investor sentiment troughs post-runtime controversy and revenue slowdown. Base case price estimate lies in the mid-$20 range, between $24 and $28, reflecting moderate recovery tied to product stabilization and cost discipline. Bull case near $35 could materialize if growth in AI-enabled ads, strong Unity 6 engine uptake, enterprise expansion, and stable macroeconomic conditions combine to re-accelerate the top line. Bear case below $20 is plausible if revenue contraction persists, developer defections continue, pricing controversies resurface, or macroeconomic pressure tightens advertising and developer budgets. For those focused on long-term growth, buying on weakness near $22 could provide attractive entry, particularly with improving profitability and margin expansion. Momentum investors may wait for breakout above $35 to signal normalization and renewed confidence. Yield-seeking investors should disregard Unity given its no-dividend policy, though it may suit growth-oriented portfolios centered on software innovation. In summary, Unity Software's transformation under new leadership and deep investments in AI, vector, and content creation tools have begun to show in improved profitability and stabilized cash flow. The next critical milestones involve returning to revenue growth, retaining developer trust, executing integration of ironSource and other acquisitions, and defending against competition in both grow and create segments. Investors should monitor upcoming quarterly results for flat or improved revenue, increase in adjusted EBITDA margin, guidance clarity, and signs of renewed engine adoption across enterprise verticals. The interplay of culture reset, cost efficiency, and platform expansion could justify a mid-$20 valuation, while execution failure could expose downside to sub-$20 levels.